Hey, hi everyone. Today we are talking about a company which is in the defense sector, and this is the right time to talk about defense sector, and you know why. So, without further ado, let's dive in. So, in this video, we'll be talking about the news section of that company. What is in the news? What are the different orders that they have grabbed recently? Then we'll be looking at the financials of the company. How is the profit looking like? How is the quarter over quarter growth looking like? And then we'll be moving forward to the shareholding pattern, and last but not the least, the strengths and the risks associated with the company, so that you are equipped to make a financial decision whether you should invest in that company or not. We are not here to just recommend this company, but we want you to equip with the right information so that you can take more informed decisions about your investment choices, and you can make better decisions and achieve financial nirvana sooner than later. So the last budget was very promising in terms of defense sector. Why I say that? Because we saw a overall increase of 9.53% in the defense budget in 2025 as compared to the 2024. So what does it mean? This means that government wants to spend more on the defense sector, equip themselves better, and it makes more sense now than ever because of the fact of the geopolitical tensions across different countries, different borderlines. Every country realizes that in the current geopolitical scenario, we are at the brink of a war across different borders. Now moving on, that is just to establish that defense sector look lucrative and you should be exposed in some capacity to that sector. Now moving on, the very first thing if you see here, Avantel is the company that we are talking about. Avantel is a equipment manufacturer company. It manufactures different kind of sonar system, different kinds of radio systems, radio frequency systems, and we will get into the product portfolio of the Avantel. But before that, let's dive into the recent wins of Avantel. So if you see, these are the just wins from the first quarter of this year, that is 2025 only. So if you see, it recently bagged a 5-year service contract from ISRO. Then it got a 43 crore order from New Space India. Not just that, then it won a very big deal from Indian Navy also. And then last but not the least, it got a purchase order of 17.7 crore purchase order from Bharat Electronics Limited. So what's the story? What's the story we are trying to convey? What's the story that we are bringing here? So the point is that the order book looks promising and it has sufficient orders or sufficient clients out there which are giving Avantel promising orders and they are fulfilling their business needs. So moving forward, as a result of this, because Avantel has recently grabbed some orders and is looking forward to expansion also, so it has decided to go ahead to raise a capital of 80.9 crore from the open market via the share issuance. Overall future is very bright because they want to expand their capabilities, they want to expand their operations and manufacturing capabilities. Now moving forward, what are the core offerings? So the very first core offering that you will see here is, it is very much related to the defense sector, and not just the Indian defense sector. This is a company which is exporting the different equipments required for the defense sector abroad as well. So if you see, it manufactures a variety of things: SATCOM networks, earth station equipments, 3D printing, assembly and testing facilities, high power test instruments. So anything related to very nuanced tech savvy things that are required in defense sector, this is the right company for that. And if you see right now in the geopolitical scenario, we need more tech heavy equipment, we need more precision based equipment for these kind of equipment, for these kind of missiles. Such kind of instruments, such kind of manufacturer are on the edge because they have the capability, they have the R&D units, they have the proper setup to manufacture and support the ever growing defense sector and equip them with the right technology that can be more precise in nature. So what are the other competitors? So on a very high level, if you see here, the PE of Avantel looks promising as compared to other competitors like Astra Microwave or Kaveri Defense. On the same time, if you see the ROCE percentage, then it is at 37% as compared to others standing at 18 or -2. So what does it tell? It tells the story that this is not just a company that is in the defense sector, but this is a company that looks promising as well. Why I say that? Because of the ROCE, they are utilizing the capital employed in a very well manner or very structured manner, which are giving them good results, which we will see in the financials also. So moving on, if you see the quarterly results, it might look sad, or recent downfall of the stock also happened because of the quarterly results, because it came out to be 49 crore in the March end quarter. But the problem here is, in the last year also, if you see, March is usually the lower side quarter, the results are not that great. But overall the picture looks promising, because 51 cr in June, then September 77 cr, 70 cr in December. So if you see year on year a more holistic picture, then it will look promising, and you don't get shaken up with the small number as compared to other quarters in the sales, because of the fact that it is a very government related sector, so the money inflow is not very frequent. It comes on a contract basis, so it might be realized, the profit might be realized in future quarters, which we are not seeing in the March quarter. And because of that, we might be thinking that it's not the right investment, or the financials are looking bad. But look at the bigger picture, look at the yearly comparison, you look at the yearly profits. We will move on to the yearly profits because of that reason. So if you see, the company is making slow and steady growth. So if you see, back in like 2022, the sales were exactly at like 105 cr. Now we are sitting at 248 cr. So in just a matter of 4 years, the company has grown almost 2.5x in the sales. And not just the sales, if you see the operating profit, this is where it gets interesting. So operating profit margin was just 26% back then, now it's 38%. What does that signify? Because if the sales and the profit is increasing at the same pace, that doesn't mean that the management is introducing some efficiencies, or they are doing something innovative to ensure that their profit percentage is increasing. And here it is very evident that the management is taking care of the innovation and efficiencies as well, because the operating profit margin is increasing. So that's a very good green flag, I would say. Then one thing, the EPS, if you see, currently it's 2.45, but as the company is planning to raise more capital, this might get diluted, because the earnings might remain same, whereas the number of shares available in the market will increase, which will impact the direct calculation of earnings per share. Now if you see here, in terms of liabilities also, that looks promising. We don't have any serious liabilities here. And then in the other assets, that's where I would like to focus on, would be the trade receivables. So if you see, there is a trade receivable of 71 cr. So this is something, the money is out there in the market and they will be getting the money from their clients. It will increase the profit as and when realized. So that is also a plus point. Now moving on. So if you see, this is something, profits from operation, I would like to focus here. So if you see, the major chunk of money should come from operations for a company, and at the same time the company should be positive in cash flow. Ideally, not every time you will find a company to be a cash flow positive, but ideally company should be generating cash from the operations, and that's the case here. The company is generating profit from its operation, and that is coming out to be 110 cr, which is again a very promising thing. Now if we see the shareholding pattern, interesting fact here. So if you see at a quarterly level, that FIIs are gradually at a very small speed coming up in this stock, because in the September month they were having an exposure of 0.11, then December 0.18, and March 0.48, and this is all happening in the times where FIIs were getting out of Indian stock market. So this is a stock which was very well positioned, and when the other stocks when the FIIs were getting out of other stocks, this was a stock which was attracting FIIs. So this has to be good, this ought to be good for them to be interested in this. Now if we see the overall shareholding pattern at a yearly level, then you will see effective last year, there was no holding of FIIs, DIIs, but starting this year, we are seeing a total almost 1% holding among the FIIs and DIIs. In the upcoming quarters or upcoming year, we might see this number also grow. So when the FIIs and DIIs are getting interested into that stock, that is relatively a good time to enter the stock, because they are also doing their due diligence, they are also getting interested, they are also reading the financials, and they are buying that stock. We will conclude this with discussing the final strengths and the final risk associated with the company, so that you can take a call that you want to get into this, you want to buy this or not. This is not a recommendation, we just want you to provide unbiased opinion about this company so that you are equipped with the right knowledge, right data points to make an informed decision. So the strengths, going first, it's showing strong financial growth. What I mean by that is consistent revenue growth, that is almost 26% growth in financial year 24 on a year-on-year basis. Then high operating profit margin. So the operating profit margin is high and the consistent revenue growth, both of them are sign of strong financial growth. Then a debt-free balance sheet. What I mean by that is zero debt to equity ratio, reducing financial risk and enhancing the stability also a bit, because there is no debt, then there is no obligation for the management to pay off, so it increased the stability of the company. Then obviously we started off with this robust order book, so it secured a significant orders from the defense sector, new space, BEL. So this is also a promising thing because there is a strong order book and we might see good numbers in the future as and when these orders are realized on the balance sheet. Then the R&D innovation. So the company is keeping up the pace with the innovation, because in this sector specifically, in the defense sector, in the sector where there are like nuanced manufacturing, niche manufacturing, there has to be innovation to make sure that they are at par or above with the current industry benchmarks. So it is keeping up with the SATCOM and the radar system also. One would be, right now the defense sector is ought to boom, and I need not to tell you why I'm saying that. You are seeing the news already across the globe. Defense sector is something that is bound to grow. So right now we see low institutional partnership. You might say it is a risk, but I see it as a strength because of the fact that in the current scenario they don't have a lot of investment in this stock, but they have shown interest via that's very minimal exposure, and gradually they might introduce or they might buy more stocks to get more exposure to this company and get more exposure to the Indian defense manufacturing sector. So this looks promising from that standpoint also. Let's look at the risk associated with the company. One would be little bit volatility in quarterly performance. So in the recent quarters, we see little bit volatility, little bit downside, but it might be offsetted in the upcoming quarters. But let's see how it pans out. But this is little bit risky or not exactly in sync with the expectations or the forecast. Then one would be the rising employee costs. So when I was going through the balance sheet of the company, the latest reports, I saw that on a year-on-year basis, the cost of employees surged from 8.8 CR to just 16 CR in the last financial year. So it's almost 2x increase in the employee expense also. So that is something that they might need to check or keep a check on so that they don't bite into the operating profit margin. The next one, dependence on government contracts. So government contracts might be tricky as it is clear from the debtor days or the cash conversion cycle or the profit variation. So when we are dealing with the government, when you will be getting the money is not confirmed. How much delay will be there happening, it's not confirmed. So this gets little bit tricky. There are pros and cons dealing with government, but it for me seems like a risk here. And then there is a rights issue dilution. So they are issuing more rights which might decrease the EPS. It is for a short term, but if the company is performing well, if the earnings are good, the profit is good, then this is not also a very big risk according to me for a long-term invest. So on an overall level, this company looks promising in the defense sector, and if you want to get exposed to a defense sector, then this is something that you might want to study or consider for investing. So subscribe for more such videos and like the video and share it with people who might be interested in the defense sector for that matter.